Mark, what is the singular sentence of your research note this morning?
That the Fed is probably going to overdo it. We have seen them turn very hawkish with the labor market strength that we have seen. That has caused us to revise up our path for the Fed. We now think terminal, top of the range, be 4.25%. And we think that the Fed will try and stick to this higher for longer mantra, but they're going to see a softening in the economic data, and the tightening that they're putting in today will risk overdoing it in the future. And that's probably going to result in a recession, an increase in the unemployment rate to around 5%. And even though the Fed doesn't want to contemplate the notion of rate cuts in 2023 or 2024, the tighter they are today, the more likely it is that they're going to have to cut over that period of time. And we're about to get a reasonably constructive CPI print. Our economists are generally in line with the street. We think that we're going to see headline CPI move lower on a month-over-month basis. Core will be a little bit stickier. This is the type of inflation that the Fed needs to see. It's going to be the start of a trend lower in inflation. And as we're seeing the start of that trend, the Fed is sounding very, very hawkish. So again, we do see risks that the Fed overdoes it. We do see risks that there's a recession next year. And we do see risks that that's going to be a continued headwind for risk assets and markets more broadly.
Mark, Mike Gapin has penciled in that recession for next year. Do you have a decent understanding of where the threshold is for this Fed to pause?
Right now, it seems very, very high. And if I had to point to one indicator and one indicator only, I would point to the labor market. It really seems like the Fed wants to see a material softening in the labor market. They're probably somewhat cautiously optimistic behind closed doors that inflation will be moderating. Certainly, most economists anticipate this. Surveys of inflation expectations anticipate this. And the market, the tips market, also anticipates this. But the Fed probably won't trust that until they see the labor market soften more meaningfully. And it certainly seems like the Fed is dead set on ensuring that they get that labor market slowdown, and they're going to keep rates as high as it takes in order to get that. Again, that just increases the risks of a hard landing or a recession in the future to us. But I do think that their focus likely right now is somewhat singularly on the labor market. Certainly, that's where we have seen the stronger data over the July intermeeting period over really the last month or two. And that's probably what has caused them to shift their tone and sound even more hawkish in relation to the last FOMC meeting.
Mark, a lot of people are expecting the CPI print to be constructive, as you said, to be lower, not higher, and to give some sense that there is this disinflationary feel. How much of that is actually due to the tightening in monetary policy?
So we think that a lot of it has to do with lower energy prices. And I heard you earlier on this program talking about the very important distinction between headline drivers, goods drivers, and services drivers. And so we think that the Fed wants to see just a little bit more of easing on the services side, lower OER, lower inflation in reopening sensitive or travel sensitive sectors in the economy. That's what we think they're going to be looking for. Now, no doubt the tightening of financial conditions that we have seen is playing a part of the broad economic moderation that appears to be underway. But really, if you look since the last FOMC meeting, financial conditions are a bit tighter, but I wouldn't say that it's notable by any stretch. And I do worry that this is a Fed that wants to see even more tightening of financial conditions in order to have faith that they will be able to achieve their 2% inflation target. Certainly, we think that the risks are skewed in the Fed continuing to sound hawkish and that continuing to be a headwind for risk assets.
Another way to translate this might be they want to see stocks go down a little bit more to give them comfort that perhaps people were buying their message. There is a question of how long it's going to take for the full effect of the tightening to really be borne out in markets, in the economy. And this is something people have been talking about, that by the time they start seeing the effects, it'll be too late to really turn around too quickly. How much will the runoff of the balance sheet, quantitative tightening, which is accelerating this week, really turbocharge some of those effects?
Yeah, it's a great point. Certainly, you're right. We are seeing the Fed tightening really kick into high gear here with broad-based expectations for another 75 basis point rate increase at the September meeting and the increase in the balance sheet runoff up to its maximum amount where caps are $95 billion a month. Now, to date, we don't think that QT has had much of an impact. And we are still somewhat cautiously optimistic that over the next couple of quarters, the QT impact is not really going to be particularly heavily felt by the market. And a part of this reason is because we do think that there's just excess liquidity in the banking system. Banks are still holding a lot of excess unwanted deposits or excess unwanted reserves, and QT does help them get rid of those deposits. So the early stages of QT, we just don't think are going to be that consequential. But by the time we get into the first half of next year, maybe Q1 of next year, we do think that you're going to start to see more bank deposit competition. That's going to be driving short-term interest rates modestly higher, and that's probably going to bite a little bit more. So again, we do think that QT matters. It's just going to probably take a little while before it really starts to bite.
Mark, I want you to help John Farrell here. He's doing the real yield from LHR here on Friday on the way out. I don't know if it's Terminal 5 or Terminal 2, but it'll be a great view of a buoyant Heathrow airport. Okay. Right now, we've got a nominal yield moving, and the partial differentials to the break-evens is stunning. There's an inertial force to the break-evens, which borders on act of God. What does that signal mean of lower break-evens right now to your world?
It means policy mistake. Again, the Fed is tightening in anticipation that inflation will remain persistent, and they feel like they really need to be aggressive in order to bring it down. But it strikes us that certainly the TIPS market is not reflecting elevated expectation of runaway inflation. If anything, the TIPS market continues to believe that the Fed is credible in its fight on inflation. And it's not just the TIPS market, it's also inflation expectation surveys. We saw that clearly in the New York Fed surveys, 3-year ahead expectation yesterday. Inflation expectations are declining as the Fed ramps up their hawkishness. So what that is doing in the rates market is it's causing real rates to rise. And it's really that real rate rise that matters more for the broad set of financial conditions. Look, if interest rates are rising just because inflation is elevated, that should have a fairly limited impact on broader financial markets. But if real rates are rising, that has a much more meaningful impact. It packs a heavier tightening punch into markets more broadly. And that is what we are seeing. And the higher real rates rise, then the greater the potential is that the economy starts to show signs of moderating and that financial conditions will continue to be tight or that financial conditions will continue to be challenged. And again, it seems like that's what the Fed is going after. We do worry to some extent that the Fed is going to go too far too fast. And we think that the 2s10s curve is going to become more inverted as a result of this. And again, we do think that the more tightening they do today, the greater the risk that they will have to cut tomorrow. And again, it is somewhat ironic in this higher for longer mantra that the Fed has been pushing for. But again, this aggressiveness today really increases the odds in our view that the Fed will be cutting in late 23 or in 2024.